Well, hello Internet, and welcome to part 2 of my financial statements tutorial where I'll explain everything there is to know about financial statements. Specifically in part 2, I'm going to go over a bunch of different transactions and how they affect your balance sheet and your income statement. Specifically, we're going to cover how to add earnings week to date to retained earnings, which is very simple. How to pay off the loan that your uncle provided to you whenever you first started your business. And if you didn't see part 1, you should definitely watch part 1 of the tutorial. You're going to be really confused here. I'm also going to show you how hiring someone to run your caricature booth is going to affect you, and taking out short-term loans, as well as the 2 different accounting methods that are available. To increase your retained earnings, you want to do this at the very beginning of all of your new transactions that will occur. You just take your earnings week to date, which was from the previous changes to your balance sheet, and roll those up into retained earnings. And you can see right here, I zeroed this part out, and this equals out to 385, but both the liabilities and the assets are still the same because we really didn't change anything. Now, if you want to pay off your uncle's loan, from the last tutorial, remember your uncle gave you $100 and he said that he wanted the loan paid off in approximately a year's time and he was going to charge you 10% interest. Well, since you're paying it off early, he's only going to charge you 5%. So what you want to do is you want to remove $105 from your cash, which you can see I did right here. Then remove $100 from notes payable since you no longer owe him that money. And remember, a notes payable is a long-term debt that requires interest payments. And then you want to remove that additional $5 from your earnings week to date, which will pay off the interest part of the loan. If you want to buy supplies, everything is going to be affected right here on the left side of your balance sheet, meaning specifically cash and inventory, whether it's raw materials or finished goods. In this case, it's going to be raw materials. So we're going to buy $200 worth of raw materials, as you can see right over here, and we're going to add that $200 here and decrease cash by that same $200. But the right side, the liabilities part of your balance sheet, is not going to be affected. Now, from the last tutorial, we prepaid 1/2 of our total rent charges for our booth at the local mall, which equaled out to $120. And it was a prepaid expense because we were not going to actually use the benefit of this expense immediately, so we held it over until we actually wanted to use it. But what happens when you show up at the mall and that money really truly is due, plus the additional $120 for all the rental charges at the mall? Well, you would want to eliminate your prepaid expenses, as you can see right here I did. You want to decrease your earnings by the total of $240, your total rental charge, which you can see I did right over here. And then you want to decrease your total cash amount by $120. And that will pay for your rental of the booth at the mall, and also zero out your prepaid expenses that were due and pay the additional $120 that was due. So that's how that affects your balance sheet. Now we come to your income statement. Specifically, we're going to get your friend Mark to sell and draw caricatures for you over the weekend, and you offer to pay him $400 for his time. And you can see over here in the income statement, Mark was able to earn a total of $1,000. The beginning inventory was nothing, but as we saw previously, we bought $200 worth of raw materials. We want to put that amount here. Since Mark sold all of the caricatures, ending inventory is going to be 0. So we want to subtract from 1,000 our total cost of goods sold, which is going to be equal to 200. That's where that comes from, to get your gross profit of $800. And then you can see down here all your additional expenses being rent of $240, paying the employee, which is Mark, and the interest on the loan, which accumulated from the transaction with your uncle. And that creates a total number of expenses of $645, which leaves you with a net profit after cost of goods sold and total expenses of $155. You want to then add this profit to your cash as well as your earnings week to date or your weekly earnings on your balance sheet. And you can see here, add sales minus the cost for Mark's time to cash, which I did right here. And then you want to move your net profit amount from the previous income statement on the previous page of $155 over here to your earnings week ending. And whenever you add all of these numbers up, you will come to $640. Remember, balance sheet must always remain balanced. Now I'm going to go into the 2 different accounting methods that exist. There is the accrual method, and what you do under the accrual method, we've actually been using the accrual method. You count all sales and expenses irregardless of whether cash exchanged hands. So if you made a purchase on credit, that was counted as a purchase, even though cash was unaffected by that. As well, you sold photographs to one of your friends for $50, and that was put into accounts receivable. Again, cash was not affected. However, your earnings were. So just remember, the accrual method makes changes to your total earnings whether money exchanges hands or not. And then you have, and by the way, this was created whenever credit was introduced into the business world. So that is where the accrual method came from. Then you have the cash method. Here we only count transactions if cash is exchanged. And that is the basics of the cash method. Cash method is normally used for tax benefits that it provides because it produces artificially low profits, which means less taxes. And I'm going to give you an example here that will explain all this. And here I'm going to give you a very specific example. We're going to sell $750 worth of total product, $425 which is going to be made up of cash, $250 is made up of credit. I'm going to give you a beginning inventory of $50, and we're going to buy $150 or enough supplies to create 150 caricatures here, which is going to give us a total of $200 of inventory available for sale. We're going to sell out, meaning our ending inventory is going to be 0, and our total cost of goods sold is going to be $200. And this is what it looks like. This is the accrual way of processing all that, and here is the cash way. Again, remember, cash of $425, credit of $250. $425, whenever you add those two numbers up though, here is where the credit is being used and here is where the credit is being ignored. This is the cash method. Again, beginning inventory is not considered cash, so it is ignored in the cash method of accounting. As you can see here, you're also going to see later on that you're not allowed to use inventory at all in the cash method. So this is actually, that is the reason why this is really zeroed out. Again, we purchased the markers on credit, so we do not show them in the cash method, but we do show them on the accrual method. This gives us a total available for sale of $200, and here a total of $105. Once we subtract out our cost of our inventory or our cost of goods sold from the sales amount, you get a gross profit of $320, while in the accrual method it's $550, and then you subtract out your cost for rent on both of these sides, and you can see with the accrual method you had a total net profit of $310, while on the cash method you had a net profit of only $80. So this is why you use the cash method. Tax benefits, that is it. It makes it look like you have a lot less money coming in, even though if you want to bring in new investors or get loans at the bank, it is 100% legal to show the bank this income statement while you would only show the government this income statement. So that's the sort of benefits you gain from using the cash method. But again, cash method, you're not allowed to have inventory. In part 3, I will continue explaining financial statements. If you do not quite get it yet, believe me, you're going to get it here. There's 2 more tutorials ahead, and by the end, you're going to understand all the different financial statements available to you. If you have any questions or comments, leave them in the comment section below. And I also provide a link to the next tutorial on this page. Till next time.